All right, let's unpack this deep dive into BSE Ltd. We've got a pretty interesting mix of sources you sent over, a snapshot from screener.in, some official announcements from the National Stock Exchange of India, and even a couple of detailed quarterly reports. Seems like we've got our work cut out for us.
Yeah, there's a lot to unpack here, but I think we can paint a pretty comprehensive picture of BSE Limited for you, hopefully uncover some insights that'll be valuable for your understanding of the company and its role in the Indian financial landscape.
Sounds good to me. Now, I've got to admit, when I think of stock exchanges, I usually picture those chaotic trading floors, with people yelling and waving their hands around. But BSE is a bit different, right?
It is. For starters, it's the oldest stock exchange in Asia, established way back in 1875. That's even before India gained independence. Imagine all the history those walls have seen.
Wow, 1875. Talk about a legacy. And it's not just old, it's also incredibly fast. It's actually the fastest stock exchange in the world, with a transaction speed of just 6 microseconds.
That speed is a major factor in their success, especially in today's world of high-frequency trading where every nanosecond counts. It gives them a significant competitive edge, attracting both domestic and international investors who value efficiency.
That makes total sense. So the difference between sending a letter and sending an email, right?
Yeah,
In the stock market, that speed can translate to real money.
absolutely. Now, beyond its historical significance and technological prowess, we need to understand BSE's financial health. The screener.in snapshot gives us a good starting point. What jumps out at you?
Well, first off, the company being practically debt-free is a big green flag in my book. That definitely makes them less vulnerable to economic shocks.
I agree. That's a positive sign for any investor. And it looks like analysts are predicting a good quarter for BSE. They also have a pretty solid history of consistent dividend payouts, which is always appealing to investors looking for reliable returns.
But Screener.in also pointed out some potential downsides. The stock is trading at 16.6 times its book value, which, if I remember correctly, is basically the company's net worth divided by the number of outstanding shares. Doesn't that seem a little high?
It can be interpreted in a couple of ways. Some might see it as a sign that the market has high expectations for the company's future growth, leading to a premium valuation. Others might view it as a potential risk, suggesting the stock is overvalued.
So it's not necessarily a clear-cut good or bad thing. It's more about understanding the context and doing your own research.
Exactly. It's a piece of the puzzle, but not the whole picture. Screener.in also flagged their return on equity, or ROE, which has been relatively low over the past 3 years. ROE essentially tells us how efficiently a company is using its shareholders' investments to generate profit.
Okay, so a lower ROE might indicate that they're not making the most of their investors' money.
It's a signal to investigate further. Maybe there are reasons for the lower ROE. Perhaps they're investing heavily in new ventures that haven't yet yielded returns. But it's definitely something investors should look into.
Makes sense.
Yeah.
Now, Screener.in also mentioned something called debtor days, which, if I'm being honest, sounds a bit intimidating. Can you break that down for us?
Of course. Debtor days is basically a measure of how long it takes a company to collect payments from its customers. It's expressed as a number of days.
So a higher number of debtor days means it's taking them longer to get paid. That doesn't sound ideal.
It can indicate a few things. Maybe they're having trouble collecting payments, which could impact their cash flow. Or maybe they're offering more lenient credit terms to attract customers, which could be a strategic decision. It's important to understand the reasons behind the trend.
It's all about understanding the nuances, isn't it? And speaking of nuance, there's one development in particular that really caught my eye. BSE's decision to divest its entire stake in BSE Institute Limited, or BIL. That seems like a pretty major move.
Yeah. It is, and it definitely raises questions about BSE's strategic direction. The decision was finalized in their board meeting on November 12th of this year, following an in-principle approval they received back in May.
Yeah, when I first read that, I immediately started wondering, why now? What's prompting them to make this change? What's going on behind the scenes?
It's hard to say for sure without more context, but one possibility is that they're streamlining their operations to focus on their core business as a stock exchange.
So perhaps they're moving away from the educational side of things.
It's possible. They might be seeing more growth potential in other areas and feel that BIL is no longer a strategic fit.
That makes sense. But it still leaves me curious about what this means for BIL itself. What happens to an institute like that once it's no longer part of BSE?
That's a great question, and unfortunately the information we have doesn't delve into those specifics. It would be interesting to see what kind of buyer they find for BIL and what plans they have for its future.
Definitely something to keep an eye on. But before we get too carried away speculating, I think we should take a closer look at those quarterly reports you mentioned. Those should give us a more concrete understanding of BSE's recent performance, right?
Absolutely. And I think you'll find some interesting details in there that shed more light on this divestment decision.
Well, I'm all ears. Let's see what these reports reveal.
All right, so we've got two quarterly reports to dig into, one from August 7th, 2024, and another from May 8th, 2024. Let's start with the most recent one, covering the quarter that ended on June 30th.
Sounds good. And remember, listeners, these are detailed financial documents, but we're here to extract the key takeaways for you. So what's the big picture?
The big news is growth, and significant growth at that. Both revenue and profits for the June 2024 quarter were up substantially compared to previous quarters. That kind of performance is sure to get investors excited.
That's definitely encouraging, especially considering some of the potential downsides we discussed earlier. But, it's all about context. What kind of growth are we talking about specifically? Any numbers that really jump out?
Well, their consolidated operating revenue grew by almost 16% year over year. That means they're bringing in significantly more money from their core operations. And their profit after tax saw even more impressive growth. It was up over 40% compared to the same quarter last year.
Wow, those are some serious numbers. I can see why investors would be pleased. But remember, we also talked about those increased debtor days from Screener.in. Did those concerns show up in this report?
Interestingly, yes. The report does mention that their trade receivables, which is basically the money they're owed by customers, have gone up. But they also provide some context, explaining that it's partly due to an increase in the volume of trades being settled.
So more business means more outstanding payments. That makes sense. It's not necessarily a red flag, but something to keep an eye on.
Exactly. It's all about monitoring the trends and understanding the reasons behind them.
Now, earlier you mentioned there might be some intriguing details in these reports. That could shed light on the BIL divestment. Anything in particular that caught your eye?
There are a couple of things. First, there's mention of a provision they've made for SEBI regulatory fees. This is related to a change in how SEBI, the Securities and Exchange Board of India, calculates option contract turnovers.
Okay, I remember we touched on the regulatory landscape earlier. Could you remind us why this is significant?
Sure. Essentially, BSE had been calculating option contract turnovers based on the premiums traded on their platform. But SEBI has shifted to a new method that considers the notional value of option contracts, which tends to be much higher.
So this change in calculation has resulted in higher regulatory fees for BSE.
Yes, and it's a significant increase. The report states that this new provision has impacted their profitability for the quarter.
That makes sense. Higher fees obviously eat into their profits. Do they give any indication of how they plan to address this moving forward?
They don't go into specifics, but they do acknowledge that adapting to evolving regulatory requirements is an ongoing challenge for the industry. It's something they'll need to factor into their strategic planning.
It's definitely a reminder that the financial world is constantly changing. Now, you said there was something else in the report that stood out to you. What was that?
It's actually in the June 2023 quarterly report, the one from May 8th.
Yeah.
There's a line item in their income statement labeled exceptional item, which refers to the divestment of their stake in Central Depository Services, India Limited, or CDSL.
So that's where we see the impact of that earlier divestment playing out.
Precisely. This divestment generated a substantial one-time gain for BSE, which significantly boosted their profit for that year.
So it's important to keep in mind that the impressive growth they've achieved in the most recent quarter is organic. It's not influenced by any one-off events like the CDSL divestment.
Exactly. It speaks to the underlying strength of their core business. Now, going back to the BIL divestment, remember that the board approved the sale of a 100% stake. They're completely cutting ties.
Right. It's not a partial sale or a merger. It's a complete separation. Which makes me wonder, is there a connection between this divestment and the increased regulatory fees they're facing?
That's a very astute observation. It's certainly possible that the increased fees are putting pressure on their financials. Divesting from BIL could be a way to free up capital and streamline their operations, allowing them to focus resources on adapting to the new regulatory landscape.
And perhaps they're anticipating even more regulatory changes down the line.
That's a valid point. The financial industry is constantly evolving, and regulations often lag behind. It's entirely possible they're making strategic moves now to prepare for future challenges.
Now, it's not just about reacting to the present, but also anticipating the future.
Yeah.
That makes this whole divestment decision even more interesting. It's like they're playing a game of chess, thinking several moves ahead.
Exactly. And we, as observers, are trying to decipher their strategy based on the moves they're making.
It's a bit of a puzzle, isn't it? But I think we're starting to piece it together. We've got this historical institution embracing technology to become the world's fastest stock exchange, showing strong organic growth, but also facing new regulatory challenges. And now they're making bold moves to adapt and potentially reshape their future.
You've summed it up perfectly. But remember, these are just pieces of the puzzle. There's always more to discover and analyze.
You know, it's funny. When we started this deep dive, I had this image of BSE as this grand old institution, steeped in history and tradition. And while that's certainly true, what's really striking me now is how much they're embracing change and innovation.
Yeah, it's a fascinating juxtaposition, isn't it? They're balancing this incredible legacy with a forward-looking approach. They're not just resting on their laurels. They're actively adapting to the evolving financial landscape.
Exactly. I mean, think about it. They become the world's fastest stock exchange. They're making strategic divestments, and they're navigating these complex regulatory changes. It's like they're constantly pushing the boundaries.
And that's essential in today's competitive environment. The world of finance is incredibly dynamic. Standing still is simply not an option. To thrive, you need to be agile, innovative, and willing to embrace change.
It makes you wonder, though, what's driving this push for innovation? Is it purely a response to competition? Or is there something more at play here?
That's a great question. And I think it's a combination of factors. Competition is certainly a major driver, as you mentioned earlier. We need to consider the broader ecosystem. BSE isn't operating in a vacuum. There are other stock exchanges in India, like the National Stock Exchange, and global players as well, all vying for a piece of the pie.
So they need to constantly innovate to stay ahead of the curve and attract investors.
Exactly. But I think there's also a deeper motivation here. Remember BSE's history, its role in India's economic development. I think there's a sense of responsibility there, a desire to continue contributing to India's growth story. And they recognize that in today's world. That requires embracing technology, pushing boundaries, and fostering a culture of innovation.
So it's not just about profits. It's about playing a role in something bigger. That's a pretty compelling narrative.
It is, and it speaks to the importance of understanding a company's values and motivations when making investment decisions. It's not just about crunching numbers, it's about aligning yourself with businesses that share your vision for the future.
Absolutely. But let's bring this back to our listener. We've explored BSE's history, financials, strategic decisions, and even touched on the competitive landscape. What are the key takeaways, the things they should really remember?
Well, first and foremost, BSE is a company in transition. They're balancing their rich legacy with a forward-looking approach, embracing technology, and making bold moves to adapt to a rapidly changing financial landscape.
And they're doing all of this while delivering strong organic growth, which is certainly a positive sign for investors.
However, there are also challenges to consider, like the evolving regulatory environment and the competitive pressures from other exchanges. These are factors that will continue to shape their future.
It's a bit like a balancing act, isn't it? They're juggling these different forces,
Yeah.
trying to maintain stability, while also pushing for growth and innovation.
Precisely. And that's what makes it so interesting to observe and analyze. There's no easy answer, no guaranteed outcome. It's about making strategic decisions, navigating uncertainty, and constantly adapting to a dynamic environment.
And that's the beauty of the financial markets, isn't it? There's always something new to learn, something to analyze, something to ponder.
Absolutely. And we hope this deep dive has given you the tools and insights to continue exploring this fascinating world on your own. Remember, investing is a journey, not a destination. It's about constantly learning, adapting, and seeking out new opportunities.
Well said. And with that, we'll wrap up our deep dive into BSE Limited. We've covered a lot of ground, but as we've seen, there's always more to discover. So keep exploring, keep learning, and keep asking those insightful questions. That's the best way to navigate the ever-changing world of finance.